Hey guys, what's up? In this episode of Connecting the Dots, I have got a very dear friend, and recently, Sir has also got his own SEBI registration. So, in today's podcast, we are going to talk with Shankar Nath. Hey guys, what's up? In this episode of Connecting the Dots, I have got a very dear friend who has also been in the YouTube space for a long period of time. He has been creating content on YouTube, a very dear friend, and recently, Sir has also got his own SEBI registration, and now he is a SEBI Registered Research Analyst. So, in today's podcast, we are going to talk with Shankar Nath, who has put amazing videos on YouTube. We're going to deep dive into his personal journey as well, and we're going to understand a little bit of stocks that he has done deep research on. So, this is going to be an impactful, knowledge packed episode. So, stay tuned. So, hi Shankar sir. First of all, I'm very excited for you because you have come here, and I know we've been in the same space for a very long period of time. So, I'm very happy. And also, you've got your SEBI registration done quite recently, right? So, first thing, Shankar sir, I want to understand how did you get into this journey of the stock market, and what led you to get the SEBI registration as well?
Sure. So, with respect to the stock market, I'm an old timer. So, I think the interest in stock markets came in way back when I was doing my MBA. This was in 2001, 2002, when the Sensex was hardly 3,000 points or something. And I was taught value investing by Professor Sanjay Bakshi.
Oh, wow. Okay. The OG of India.
Exactly. OG of value investing, right? So he used to teach us, and those were like amazing lessons. I still have those presentations with me from 2001. So that's where the interest started for kind of dwelling into the stock markets. 2004 is when I really got into it. Did some 2004, 2005 till 2007 was a period when you can just throw a dart on any stock and it's going to do well.
Yeah.
So
the pre-bull market.
The amazing bull market that happened between 4 and 7. So that's how the interest started, and but I really got serious into it only from maybe 2018, 2019 onwards. Started to put in small things and put in money, but I think the bigger emphasis here is to understand the company that you're getting into.
Okay.
Because that's what the lessons are, obviously, right? So I could never dabble with charting or technical analysis, those kinds of things. And I think one of the reasons why I could not kind of delve into those things is because of that history. That's why I wanted to explain you Professor Bakshi's influence on my thinking.
Yeah.
Because he comes more from a value investing kind of a methodology.
Okay.
It's about the company, it's about the special situation, stuff like that. So that's how the entire genesis happened for me.
Okay.
With respect to investing.
And what led you to get into SEBI registration, like become a registered advisor?
So multiple things. One is this entire push that was happening for content creators to move into a SEBI licensing.
Yeah.
I think that's somewhere that definitely played a part. I was basically, I've been in a regulated business almost all my career. Right from ICICI Bank days in 2003, I've been in businesses which have been regulated by the RBI, by SEBI, by PFRDA, Correct. By IRDA. So I don't feel regulation is a problem actually.
Yeah.
It's only that that it has to be a win-win kind of a situation. It should not be too cumbersome. And when I noticed that SEBI is kind of relaxing its norms on research analysts and stuff, I said, okay, I think it's a good time because I can see more goods than bads happening for me, and I picked up.
No, because I remember at that point there was a lot of noise in the market and a lot of people doing scams at that point, right? And now I think they've relaxed it quite a bit.
Yes,
like even if you're from a non-finance background, you can get a license and all of
Correct.
that. But amazing. So Shankar sir, I have seen your YouTube videos and they are very good with respect to how you deep dive into companies, and you've been doing it for a very long period of time. So first, what I want to do is I want to understand a little bit about your fundamental analysis, right? Is there any company that you really like or liked in the past? Like I just want to understand one thesis of a company that you liked, like a winner.
I'll give you the examples, but just to give you the kind of just to layer the approach per se,
Yeah.
I'm really looking at companies which kind of follow the GARP methodology. So
Okay.
they're
What is
basically-
GARP? If you
So
can.
GARP is growth at reasonable prices.
Okay.
So you want companies which are growing.
Correct.
They're growing their sales, they're growing their profits, probably growing their EPS as well. And you don't want to pay too much for it.
Okay.
It's like shopping in Karol Bagh.
Correct.
So you really want value for your money, correct?
Yeah.
So that's what the GARP methodology tries to determine.
Okay.
So essentially, I look for four things. The EPS should be growing consistently and at a decent rate. When I say decent rate, I'm looking at least 15 to 20% per annum.
Okay.
I'm looking for valuation comfort. That is, it should not be too expensive. It can't be like Dixon Technologies, 100 Kapi, and all those Azad Engineering and all that stuff. It has to be more reasonable. So generally, I'm comfortable only if the price earning multiple is less than 40.
Less than 40.
Yeah.
Okay.
You have to match it with the growth also.
Of
right?
course.
So if you have companies which are growing well, you won't get it at 10.
Correct. Of course not.
You'll have to pay 40, maybe even go up to 50 also,
Yeah.
right? So that's the second thing I look for. The third is I look for businesses which have, which are unique businesses. Because unique businesses have that ability to create a competitive moat, what other people can't do. If you're going to pick one more steel company and kind of try and ride the wave, it's not going to kind of work out over the long run.
Correct.
It's very short-term, cyclical kind of a thing. So I'm looking for unique businesses. And lastly, I'm looking for honest management, which is by far the toughest thing to essentially gauge.
Yeah.
Between these four things, if you can find companies who can ascribe to these four criteria, I think the odds are in your favor.
So how if a normal guy had to find this, is there like a screener that you have made for yourself personally to check this? Like I know you said EPS growth 15% year on year, P ratio less than 40 or 50 depending on the valuation comfort you have. Apart from that, how do I find these companies? Like do I read somewhere or is there a
should read
screener?
a lot. Reading helps definitely, but you can also try the screener approach also. So if I want to do it right now, what I would do is I would do 10-year EPS growth greater than 15.
Perfect.
And 7-year EPS growth greater than 15.
Okay.
And 5-year EPS growth greater than 15 and 3-year EPS growth greater than 15.
Wonderful.
So I get the consistency of 15% across so many years,
Yes.
right? Number one. Second, I'll probably say P ratio less than 40.
Okay.
So I get a valuation comfort also along with it. For unique businesses, one way of doing it, I'm not kind of saying that this is the only way, but one way of doing it is look at the operating profit margin.
OPM.
Yes.
Okay.
So generally for these unique businesses, your OPM will be on the higher side.
Correct.
Okay, this can be a tech-enabled business. This can be something which has
like a platform business or
a platform business, and not only technology. Outside of technology, let's say there is a company like Vishnu Chemicals, which has mines. Those chromium mines, and chromium is required for creating stainless steel.
Correct.
You can't make stainless steel without chromium, right?
Yeah.
And here's the fun fact here that China consumes 40% of the world's stainless steel, but their chromium ore deposits is only 2%.
Oh, so they're actually importing a lot of chromium.
Import it, yes. So they have to import it from countries like India, South Africa, where these things are available.
Okay, very interesting.
So this is the uniqueness of that particular business, right? So as long as there's stainless steel demand, people have to come back to these companies to kind of get their raw materials, right?
Yeah.
So
OPM you would keep maybe about 10, 15?
No, I generally look at more than 20%.
More than 20%. So OPM about 20, EPS growth as you mentioned, and P less than 40. Here you should get a good set of audience. Then you have to go obviously deep dive and learn about it.
Yes, correct.
Got it. So any good company that you've seen in the past?
So there are, in fact, the top 4 companies which I hold.
Let's talk about one by one, yeah.
Yeah, so I think all of them kind of ascribe to it. When I bought them, they might be cheaper, but now they are like a little expensive, but just to get that understanding. So for example, if you look at a company like Caplin Point Labs, okay, they
pharma
company, and largely into Latin America. That's where they've created that unique business for themselves. So in Latin America, in that South America, Central America, you'll see that I mean, a lot of distribution that's happening of pharma products is
Yeah.
from Caplin Point Lab. The EPS growth is consistent and it's suspect sometimes. It's like going very linearly.
Yeah.
You feel, oh my God, what is happening? But apparently they have their strategy around it.
Yeah.
And they've been growing consistently now for the last 20 years. I think they got listed in 1995 or something.
Wow.
So what? It's 30 years now, right?
Yeah.
So they've been going consistently.
So
like
sales growth
clockwork.
is also there, EPS growth is there.
Yes.
And as far as I remember, it's a debt-free company as of now.
It's a
as
debt-free company. The valuations, if I'm not wrong, currently it's around 28, 29
Yeah.
P or something. When I
Correct.
bought it was cheaper.
Yeah.
So it's done well.
Yeah.
And, I mean, we know this, right? If the company stops growing, do what may, your stock price is going to crash
Of
down,
course.
rise to nothing. So it's as simple as that.
Yeah.
Same way there's persistent systems.
Yes.
Yeah, it's now very expensive.
Now it's expensive.
Yeah,
Yes.
probably it's, I think if I'm not wrong, 70, 75 or something is the P ratio. When I bought it was like in the 20s.
Okay.
Okay.
Wow.
And it was growing consistently.
Okay.
So I got that, opportunity at that time to kind of look at that particular company.
But how did you capture this? Because I think prior to 2020, Persistent was not doing that great, and then the new CEO came in around that time, and then the growth actually every single year started compounding.
So I look at 3-4 quarters. So I'm not someone who will just jump on a news.
Got it.
So I need proof of concept, right?
Yeah.
So once the proof comes in that every and with IT companies, especially these kinds of companies, these are not cycles per se.
Correct.
Okay, you can read a lot on what is exactly happening. So these guys actually reveal that I signed up 3 Fortune 500 companies in the last quarter or whatever, last year or whatever. So you can actually make out that how is this increasing from time to time. And the same thing can be extended to other stuff also. So for example, if a company were to acquire a smaller player,
Yeah.
that there's going to be a revenue bump because of that coming in, right? So I think that's when I said that reading is very important beyond the screener also, and that helps.
That happened with the twin of Persistent. The Coforge and Persistent were like the two IT twins.
Exactly.
And they, I think, acquired a smaller company at that, Signity or something like that.
Exactly.
Interesting. And have you seen any high OPM companies in the recent past that have done really well?
High OPM companies? Yeah, I did a video recently, Tips Music.
Okay, can we talk about that?
Yeah, we can. Sure.
Yeah.
Absolutely.
So what did you, I mean, if you can give us a deep dive about this industry, what happened and something that moved in that industry?
Yeah, it's a very interesting one because if you look at, again, screener data, financials, until FY 2019, you'll see that this company was doing consistently 3 crores of PAT. That's it.
Okay.
Just 3 crores.
Okay.
Today it's 170 crores.
Okay, in 5 years?
Yes.
Okay.
So the question is, what happened in 2020 onwards that 3 became 15, then 30, then 60, then 100, it's now at 160.
That's a lot of compounding.
Yes. So that's what the trick is, right? So you try and understand. I always tell people that if you want to do well in investing, there are only 4 questions you need to answer yourself. If the sales are doing well, why is it doing well?
Correct.
If the sales are not doing well, why is it not doing well? If the profits are doing well, why is it doing well? If the profits are not doing well, why is it not doing well?
Correct.
If you can answer these 4 questions, you have understood the business model of the company.
Beautiful.
Okay, so I think the same applies for Tips Music. The biggest catalyst has obviously been a lot of movement towards people consuming content on streaming platforms, which is both YouTube as well as your Spotify, Apple Music, Ghana.
Okay.
All these guys.
So just to give the audience an understanding of Tips, right? So first Tips had this music business and the film business as one, and then they broke up in 2020 and the Tips became Tips Music.
Correct.
So then if you can give us an idea of what exactly happened after that.
Sure. So a music company has certain assets. Now you and I know what these assets are. These are the songs that have been created. So when the demerger happened, then all the music collection of Tips that went into Tips Music.
Okay.
How many songs are we talking about? We're talking about 31,000 songs.
31,000 songs.
Okay. Now the history of these songs are, this company Tips was formed in 1988. So in the 1990s, they did a tremendous job. In fact, you pick out the 1990, how old are you?
I am 1992.
92. Okay.
Yeah.
So Yeah, so
90s
my
kid.
generation, 1990s, we used to listen to a lot of Alka Yagnik and Kumar Sanu and
Correct,
Udit
correct.
Narayan, and
Yeah.
the lyrics were always Sameer.
Okay.
There was a guy named Sameer, he used to write lyrics, all these songs. We used to watch a lot of Govinda, David Dhawan,
Yes,
this
yes,
thing.
yes.
So Tips had a lot of those songs in their repository.
Okay.
In fact, 60% of the songs created in the 1990s, Tips has it.
Okay.
Okay, so I'll give you some movies also. Coolie #1. Have you heard of this movie?
Of course.
Yeah.
Of course.
Okay, so this was again one of those 1990s creations, and those songs are with Tips. Now, the life of a song, as per the Copyright Act, is 60 years.
Life of the song, according to Copyright Act, 60 years.
It's 60 years.
Okay.
As in, for 60 years, no one can touch that particular song.
Okay.
Okay, so the asset has already been created by Tips Music, and it can work that asset, sweat that asset for the next 60 years.
Okay.
So that's what Tips is currently doing.
Okay.
Okay, it made those songs in the 1990s. It's still able to kind of make money out of it. I'll come to how they make money.
How would they make money? Because most of the thing usually is free, right? Like
No,
I
it's
can
not.
just-
It's not
okay.
free. So when let's say an event, they play this song, "Husn Hai Suhana," from that movie. They have to pay money.
Okay.
You can't just put that song anywhere,
Okay.
right? So they have to pay money. This on the radio, if that song comes in,
Okay.
the radio station pays something like 10 paisa
Every time they play it?
every time they pay it.
Okay. So there's a licensing cost that the
There's a
B2B
license
guys
cost, correct.
kind of pay.
So in India, they have given it to this company called ISPR or something.
Okay.
Okay, so they are the ones who kind of syndicate this content to, let's say, a radio station or to a event management company or stuff like that. And every time it gets paid. So there's a way of actually calculating. There's a counter somewhere that is calculating kitni baar wo play hua.
Wow.
So multiplied by 10 paisa, that money has to be paid to Tips Music for this particular thing. On YouTube, it's easier. It's something that you and I understand. The advertising part that happens. So 55% is given to Tips Music, while 45% is retained with YouTube. A lot of money to be made there. Then on Spotify, again, every time that song is getting streamed, they pay some money to Tips Music.
Because it's a paywall app.
It's a paywall app.
Okay.
Even if it's not a paywall app, they have to pay money.
Irrespective, because you're licensing it.
Irrespective. Yes, correct. So what has now happened is, this is very interesting because you raised this paywall thing. This paywall thing is more of a recent stuff, actually,
Correct.
especially in India. Okay, people like Spotify, they used to have it free of cost for a pretty decent time. And now you have Spotify, YouTube Music,
Correct.
Apple Music, Amazon Music, all these guys are there. Because of the paywall coming in, it's kind of disturbing the growth trajectory of Tips Music.
Okay.
So just to give you some numbers, I think in FY22, the company grew by 50%. The revenue grew by 50%.
Of tips.
Of Tips.
Okay.
In FY23, it grew by one of these years, grew by 40%.
Okay.
FY24, 30%.
Okay.
FY25, 30%. Now, FY26, this financial year, the management, for the first time, they were always singing this tune, we'll grow by 30%, 30%. The first time, Kumar Taurani says that, 20% will definitely happen. We'll strive for 30.
Okay.
So why is this confidence kind of waning a bit? It's because of the paywall coming in more rigorously. And because when a paywall comes in, a lot of people like me who were listening to free music, we kind of think twice
before
spending
spending
money.
I would rather go to YouTube and play it. Oh, but there also there is YouTube Premium. So
There's also YouTube Premium, correct. And there is YouTube Music as well, right? So all this kind of plays in. The way you got to think, and again, this connects back with your original question, is that, uncertainty is a part of every business.
correct.
You have to give it time. That this 20% growth has, it's kind of waned down to probably a 20% or something like that. This might persist for 1 year. It might persist for 2 years also. It's possible. You got to think a little deeper to the next layer, saying that, but what's the real asset?
Yeah.
The real asset is those 31,000 songs. And people like you and me, we are still going to listen to those songs.
Of course.
It doesn't matter. Even if we don't listen to it on Spotify, we'll listen it somewhere or the other, we're going to listen
He'll
it.
still get his money.
He'll still make his money.
Interesting.
So that's the difference between risk and uncertainty. Risk is the chance of making a loss,
Correct.
which can be permanent loss also. It can be a partial loss also.
And it's a high profit margin business.
Yes. This is also very interesting. So for every 100 rupees of revenue that these guys generate, they spend on an average between 25 to 30% on content.
Okay.
Let's say spend 25%. Their employee cost is only 4%.
Okay. 29%.
Because there are hardly some 100 employees there. There's no other cost.
So गाना एक बार बनाओ and then
हाँ.
चलता रहेगा for the next 30 years annualized.
And here's the best part. वो जो गाना बनाते हैं ना, that गाना is written off in the same quarter.
Expensed out in the same.
They don't capitalize it.
Okay. And then for the next 20, 30
And
years.
they enjoy for the next 60 years.
Wow.
And then what they do, this Coolie number 1, this Husn Hai Suhana, they make they do a remake of that.
Okay, I saw it with Varun Dhawan recently.
Varun
they
Dhawan,
had done
exactly. So they made a remake of that. So now they've extended that by another 60 years.
And that again becomes their own song. Earlier song is also there
their
for
song.
60 and this is also for 60.
Correct. And
So
that
this is a
Varun Dhawan
recycling
song,
business. Huh?
Exactly. That Varun Dhawan song, that Husn Hai Suhana, it's got 24 crore views on YouTube.
Okay. Wow. Wow. So then can I put it in a different way? Can I say that with internet adoption going up so much, number of views will always increase in India with shorts coming in with
Correct.
those songs?
That's an additional revenue source they are exploring. So right now their deal with YouTube Shorts is that YouTube Shorts is paying them a fixed amount of money.
Oh, YouTube, Instagram and YouTube pay for the license for the songs on Reels as well?
They do that.
Okay.
So YouTube Shorts is separate, YouTube is separate.
Why
YouTube,
they don't pay creators for Reels then? Okay.
So YouTube Shorts
Next
is
topic.
paying them.
Yeah.
Now it's up for renewal next year.
Okay.
This contract with YouTube Shorts, and Tips Music now wants to move from a fixed payout to a per stream revenue sharing, which can either be through an advertising kind of a thing or some other model. But they are saying, so probably that experiment has worked in favor of YouTube Shorts, which is why Tips is saying, hey, you need to kind of rework this thing and give me my streaming
So
revenue.
one viral video with everyone playing the same song in the background
That'll
could
go crazy. Correct.
Yeah.
Correct.
Oh, very interesting company. But in the recent past, Tips has fallen down. Obviously, they had that huge rally,
Correct.
very, very big rally of thing. And
It's
I
because
think,
the growth estimates have come down.
but 20% is not bad. But because they fell from a larger base?
See, you're looking at that 50, 40, 30, 30. So when someone would have made the estimations a year back, he would have assumed a perpetual 30% or something like that.
Correct.
But when, the MD says that it's going to go down to probably 20%, secondly, the valuation was a bit high.
Okay.
Even now, the valuation is not like
It's around 40, 50 -ish
45. Yeah, correct.
45.
Yeah, it's there.
But if a person is looking at long term, let's say with Sanjay Bakshi's principles that you also learned, how would you analyze this?
So one simple way, let's take 20% as your perpetual this thing. Okay. So effectively, what is the P ratio of 45 right now? In the next 1 year, so we're basically calculating forward P ratio, right? So 45 divided by 1.2.
Correct.
How much does that come to?
Around 48, 49, 50. Approximately 50.
No, 45 divided by 1.2.
Divided by, sure, I did multiply. Maybe around 40. If you're saying
Yeah.
20% growth rate, almost 8 will go away. So 37, 38.
37,
forward
38,
P,
right?
Yeah.
So extended over, let's say, a couple more years. Okay, even if it's at only 20%,
Yeah.
you're probably seeing this coming down to about 20.
20p.
Yeah.
5 years
So
forward.
now,
yeah.
if I tell you, okay, there's a company which is probably going to do 20%, it's in the next 3 years, it's going to be around a 20 kind of a this thing, and it has no debt. It has assets which are not running away. Suddenly we'll not stop listening to all these
And high cash flow business.
high cash flow business. Cash flow is extremely good because they have nothing to pay.
Correct. Yeah, you're right.
I mean,
Do they give dividends or bonus and all?
they do give dividends.
Okay,
In
very
fact, now because they don't know what to do with that money, what they're now doing is, I read it somewhere in the earnings transcript. So the MD says that whatever is the last year's PAT, we will give it across as dividends.
What are you saying? Wow.
Something like that. So either it's a mix of dividends. They've actually been doing buybacks.
It's very smart. Very smart.
Last 3-4 years, they've been doing buybacks as well.
Wow. So a company that was not making revenue at all is suddenly now seeing a huge cash flow coming into the system.
And the same thing works for this competitor of theirs, Saregama. T-Series is not yet listed. So T-Series is the daddy
The
of
goat,
the...
goat of everything. Yeah.
So it's not listed, but Saregama is listed.
Yeah.
Saregama is doing multiple things. Tips Music has just stayed with music. T-Series is also only with music. But even Saregama, it's the same fortunes changing for the better.
Yeah.
It used to be 6, 7, 8 crores in 2017, 18, 19. And somewhere in that period. Now it's like 200 crores.
But they've not demerged the business. So they
They've
have
not demerged
100 things in that
They
business.
have a lot of things inside business. Correct.
But the day they demerge, it will be a gold mine in the making, right? Because you have out of 3, you have 2 of the biggest guys listed.
Maybe, correct. Correct. I feel a little uncomfortable with businesses that are very complicated.
Yeah.
So if you tell me do an analysis for Reliance, I'll find it very difficult.
This is simple.
Okay, now this is simple.
Yeah, music soon.
It's simple, and I have a preference for businesses which are small caps or micro caps
Okay.
because of multiple reasons.
Below 10,000 crores?
Below 10,000. I can even go down to below 500 crores also.
Understood.
I picked up one recently, Fredun Pharma.
Okay.
It was some $800, $850.
Yeah.
So I started around 800-ish something. Then I averaged up. So now I don't want to make that mistake which I used to do earlier, that I would just sit on my laurels.
Yeah.
कि एक बार सस्ते में खरीदा, and then I'm saying, oh, देखो कितना बढ़ गया है. But I'm not making wealth.
Yeah.
I'm showing a percentage to myself, saying, oh, I've got a it's growing at probably 30-40%
Correct.
or something, but I'm not making wealth. So now I average up. I did the same thing with Himadri Specialty.
Okay.
When I bought it, it was at 42 rupees. Now I think it's at 500 plus, if I'm not wrong.
Yeah.
But I didn't stop at 42. I picked it up a bit more at 100.
Yeah.
I picked it up at 400 also.
Got it.
And after 400, it actually came down to maybe 350 or something. But now it's again up to 500 or.
But you've done deep research in all of this.
I did.
Yeah. I just want to tell the audience, just like, because we are supposed to say this as well, because we're also analysts. So I'm just saying that whatever stocks we're mentioning right here, we have done deep research into it. And we know exactly what is the risk, what is the reward, and how do we exit. So please do not copy these things. This is not a buy or sell recommendation that we're giving you right now. Okay. This is something that we're telling you out of experience and what we've learned. And we've done deep research on it. That is why we're talking about this. And on that same lines, I want to ask you another question. How do you define an exit? Right? Because if your criteria to enter was low P, now, do you exit on high P or do you stay put? Like, because now that's a very complicated thing.
I stay put.
You stay put.
I stay put. I don't fear highly valued business.
Okay.
Because a highly valued business means it's valuable. And people are giving it a lot of value. They say, right, it's value is basically it's the eye of the beholder.
Correct.
So if people are seeing this as a valuable business, then why would I exit?
Correct.
It's not a problem. I exit for other reasons. One of the primary ones being if the management starts doing hanky-panky stuff.
Okay. What define hanky-panky? Like, what is hanky-panky? Like,
Do it with a stock only. So, for example, Aurobindo Pharma. Okay. Low P, growing, सब अच्छा लगता है देखने में. But for some reason, the promoter does something every 3-4 years, which kind of makes me very nervous.
Okay.
So, for instance, I think 2-3 years back, they bought some company. I don't remember the name of the company. That company was doing some revenue of, if I'm not wrong, it was doing revenue of 5 crores or something like that. A very low number. They bought it for some 400 and something crores.
100x price to sales.
Yeah. What is happening? And then 2-3 days later, the entire, obviously everyone is researching and trying to figure out what is happening. So I read up on Twitter that there is some corporate governance related party has there, that friend or something like that is there. Oh my God, what is this? Sikar ke? And Aurobindo Pharma then cancelled that deal.
Okay. Interesting.
Because I think it was like
too big.
Someone must have threatened them that, guys, we're going to do this thing. So I don't kind of like such companies.
So management going off track is one logic?
Yeah, so this is corporate governance, but there can be other things also. For example, although I do own this share also, not too much, but it's there. Garware High Tech Films, for example, right?
That did well a few years ago.
Yes. Even recently it did well, but then, it's been like extremely volatile. It's like insanely volatile.
Okay.
So it's par for the course for me, I think, at the moment. Now, in this case, this gentleman, this Garware family, come what may, they will take their 11% of PAT as their compensation.
Oh,
वो लेना ही है. Because the law allows it.
wow. Okay.
So they will take that 11% come what may.
How do they take? Like dividends?
No, salary.
Salary, सीधा ऊपर.
Salary,
Okay.
variable, सब डाल के, they just take that 11%.
My God.
So, nothing bad. ठीक है, उन्होंने अब बनाया है वो company, I can understand that. But I'll give you another example where I feel that's like stretching it too much. So, for example, Sun TV networks.
Yeah.
The Marans would take in that 11%. वो मेरे को इतना allowed है तो मैं उठा रहा हूँ करके. The issue starts when you start comparing it with the total wage bill of the company. Now, Sun TV is not a small company.
It's a huge
got a lot of employees, right? But when you examine the amount those two executive directors made as compared to the total wage bill of the company, those two guys took 57% of the entire wage bill of the company.
So entire employee benefit expense, 57% is just two people.
Just two people.
Yeah. That's out of the shareholders' pocket.
It's out of the shareholders'
Yeah.
pocket, correct. So, I find it like, this is
It's
too
fine.
much.
That's like a red flag that you look at.
So, it's a bit too much for me.
Okay.
That's kind of stuff.
So if I had to ask you one mistake or learning that you got, like let's say something that you had a thesis on did not work the way you wanted to, or maybe gave you a huge time correction, like one loser in the portfolio that you learned a lot from, what would that be?
As a trend, what I've learned is that don't run behind order books per se.
Oh, that was very famous in the last 2 years.
Yes.
Yeah.
So,
even today a little bit, but last 2 years it was heavy.
And I have now come through the realization that nahin.
So did you have an experience
Yes,
through that?
yes. A few of them actually. Not just order book, but even lofty plans of people. So for example, JTL.
Yes, yes.
Okay, lofty. क्या महाराष्ट्र में हमने कुछ 10 lakh metric tons का कुछ किया है and all that stuff, I know it takes time to develop this kind of stuff. But then you're seeing that, hey, it's not probably reflecting at all in any this thing. The other thing is the change in storyline. So, for example, Sterlite Technologies. I used to have this stock. It's now really down. I exited at some minus 10%, 20% or something. But then, see, what I was noticing is that in a quarter, they will say, we'll do X, Y, and Z. In the next quarter, Z is away.
XY.
अब सिर्फ XY रह गया, and then they have introduced A. And then by quarter 4, XY is completely gone. And now there is ABC and whatever.
Okay, very confused management.
मतलब, what is happening?
Yeah, yeah.
So, again, the lesson here is you have to read the earnings call transcripts.
Correct.
So you read 4, 5, you'll start getting that picture. Even with tips music.
Yeah.
Because I read the previous ones, I know this guy was like 30 to ho jayega ji hamara karke. And then the latest one, when the words that are coming from his mouth, you just understand it and you know it. That
And it can go down further also, right? It can go down to 15 if required.
It can. When I look at the Q2 thing, I'll understand that further.
Yeah. Interesting.
But these are how these different things keep on working. Some of the theories did not fall through quite well also. There's a very recent news. It happened in the weekend. BLS International.
I saw that.
Yeah, the MEA putting that stop on any future tender participation for BLS International.
That's hard.
That's happened.
So would you exit on that news?
No, I won't.
Okay.
I'll give it at least a couple more quarters to see the impact of it. Also, if you look at from a mathematical basis, what are we saying? This MEA contract per se, it's about 12% of the revenue. And it doesn't affect the existing business.
They can't take more.
So it affects the growth a bit,
Yeah.
right? So, but if you see from a mathematical perspective, it's not the end of the world. It's 12% of the revenue for the company, and it's 8% of the EBITDA of the company.
So now you will wait for the management to see how they're going to play this game.
See, in 2 quarters, anything can happen.
Yeah.
The management might make a representation to the MEA, say कि sir ये तो हम कर सकते हैं, this thing है. We have solved these problems that we're talking about, some court cases or something, maybe some customer
So do you
complaints or
average at these points or do you just let it be?
I
Or do you
just let
wait?
it- I wait.
You
I
wait.
So I want to pick up only when it's like really down.
But
when
you know the thesis is still valid.
thesis is still valid. That's very important.
Very interesting.
That is extremely important for people to understand.
Very knowledgeable. And I want to ask one more thing. I think this is something that I ask a lot of guests. What is that one book that you would really recommend our audience to read when it comes to learning something?
One book is a bit
Give more, no
tough.
problem.
Let's
Absolutely, you can give as many as you want.
if you really want to get hardcore, as in, we all start with
Yeah.
books, and generally the thing most people say is intelligent investor.
Yeah.
But I would say rather than intelligent investor, security analysis is like
Is good?
Is better.
Security
actually.
analysis.
Yeah.
Okay.
You might not understand half of the stuff because it's based out of, the US environment. Number two, it was written in 1934. There's a lot of bonds there, this thing. But it still captures the real essence of how to look at companies per se. Maybe I can give you a small example also.
Yeah.
There's a very simple concept. It's called net current asset value.
Net current asset value. Okay.
What is net current asset? It is your current assets minus current liabilities. For your viewers, current assets means all your any receivables that you have over the next 1 year, basically, and liabilities is whatever is payable over the next 1 year. Okay, your obligations for the next 1 year. Now, what Professor Graham says is that if the value of your current assets minus the value of your current liabilities is 1.5 times of your market cap,
Okay.
you probably have a winner. Because even if the company gets completely liquidated,
Yeah.
there is still enough inside that company so that you as a equity shareholder will get some money out of it.
Got it.
You
Very
make some returns out
undervalued,
of it.
basically.
Extremely undervalued. Now, you heard of this company, Mazagon Dock Shipbuilders?
Of course,
Everyone
everyone's
has. In 2022, one of the current assets is cash. It's the purest form of current asset. Even better than receivables.
Yeah.
Cash is cash, right? Cash inside Mazagon Dock Shipbuilders in 2022 was 11,000 crores.
Okay.
The market cap of the company was 6,000 crores.
Oh, wow. Okay. Wow. Okay.
So this is that principle. And where is Mazagon Dock Shipbuilders today?
Much, much, much higher than
80,
6,000.
90, whatever thousand. Yeah. So it's about 15 times more
Wow.
in value. So this is one of those Alice in Wonderland situations.
So if I had to put this in screener, again,
Yeah.
actionable content for people to understand, would it be cash reserves greater than market cap, or would
cash
it be
equivalent, but there's a problem there. You
because
can't
the
try this.
liabilities would come there, right?
No. With cash equivalent, the problem in screener is that it doesn't take investments.
Correct.
And investments के अंदर आपके all your liquid mutual funds are inside.
Correct. So how would you put this on? Is there a way to put this on screener?
Yeah, you have to try current assets minus current liabilities multiplied by 2 by 3.
Because you can make a custom screener as well.
You can make a custom screener, but I can't take cash plus investments because investment I don't know.
Correct.
It can be liquid funds also. It can be some other investing in some of their subsidiaries or something. So I think one thing you can try for now is your current assets minus current liabilities under brackets is multiplied by 2 by 3 is greater than MCAP.
Okay. That's a good way to do it.
And you can have a secondary
You can
condition
do a
there.
debt to equity filter also just to
You can have a
remove all
debt to
the-
equity filter, or you can have a cash equivalent is at least 50% of current assets or something like that.
Got it.
That might be a little tough, but
I did this once because in US there was this concept of FCF yield and also this same concept
correct,
of.
yeah, correct.
So I had actually found one or two platform companies.
Yeah.
I remember I had looked at a company called IndiaMart at one point. I think they had 50% of their cash was assets, like something like that, right?
IndiaMart has been a disappointment for me.
It has been a
actually.
disappointment, but it
Very
had
big
come in that
disappointment.
screener, Just Dial, IndiaMart.
Yeah.
I think market cap, if it was 100 rupees, 50 rupees was just cash on books.
The only thing with
But they didn't move. I mean,
the only thing with IndiaMart is that when I first looked at IndiaMart, I was like, oh my god,
Beautiful.
this guy has all the possibilities in front of them.
to actually do a good job.
He can do whatever.
Yeah.
I mean, what I thought? I thought IndiaMart will do what Amazon does.
Yeah.
That is, it knows which are those SME, whatever, piston, jo bhi hota hai, what is really moving in the market. They would actually set up their own manufacturing there and they will be able to push
Like
that
Amazon
better.
Basics,
Private label bana diya.
Correct. नहीं हुआ.
these guys are stuck with their, we are a software company.
Yeah, and then a lot of these other competition has come, Udan and all in the unlisted space, B2B.
They will do all that.
They all started,
Which one is that? That infra.market.
Infra.market, Hella Infra and
Hella Infra, correct.
Of Business.
Correct.
They actually did what they should have done in that point.
So the problem with IndiaMart is that they stuck to their, I am a software business. So they bought this Busy Bee, this accounting software, Ye software, Wo
Lots
software.
of acquisitions, yeah.
They have bought like 7-8 companies, but we're really not seeing it at the moment.
Yeah.
Otherwise, the business, the core business. So it's a very old joke. There is, so this man is a businessman and he's meeting a friend over dinner.
Yeah.
Businessman is like, do you know any consultant?
Yeah.
Who can help me grow my business? And this friend says, yeah, I know this Harvard guy. I'll put you in touch. And so this happened. And then these guys met after another 3-4 years. So the friend asked him, hey, I gave you that consultant. Was he helpful? And the businessman is like, yeah, sort of. He's like, what do you mean sort of? Well, see, initially, before we met, 100% of my profits used to come from my core business.
Yeah.
So this consultant came in, he told me to diversify into 5 more businesses. So I diversified. Today, my original business gives me 200% of my profits.
Okay.
So basically those 4 other businesses that this guy created was basically loss-making.
Loss-making. Oh my God.
So, this is, there's this word also, right? Diversification and stuff like that, right? So it's kind of that same thing that in case of IndiaMart, I think their core business is still there. It's very much there. It's their cash cow at the moment. But they're not able to get that second layer that, what do they do next?
Correct.
To kind of push it up. This is where I respect Reliance to that thing that, from a petrochemicals company, they completely flipped the switch and became a telecom company.
Their integration and all is superb.
Exactly.
They just know exactly what to do.
Exactly. And now they're into so many things, right?
Yeah.
So again, exactly what I said, proof of concept. You know, I can gesticulate that, this company might be this, kitna uske paas growth runway hai and all that stuff. But ultimately it comes down to that execution.
Absolutely. I think, Shankar, I think now we're almost out of time. But this was very, very, very useful. I think mainly for people who are watching this to get a different idea of how you invest, right? Because we only see you behind the YouTube channel. So now it's nice to see you very unfiltered like this and talking
We talked about so many stocks.
So many things. Yeah. By the way, guys, again, a big disclaimer. None of this is a buy-sell recommendation. So please look at it from a learning experience. As you've seen, Shankar, you've been very open with how you do it. Like as if you're sitting...
I'll tell everyone makes mistakes, right? Including you, me and everyone.
Absolutely.
Okay, so no one is
a lot of people are very reserved. I think you've been very open and very natural, right? You've not put anything as a hidden kind of a concept, which is something I appreciate a lot, right? So again, thanks a lot for that. And I really look forward to more amazing videos on your YouTube channel. I think you should do much more because we were watching it in the flight as well, the 2 videos that you put out. Very, very, very good. Again, thank you here for coming here and spending some time on this podcast. Really appreciate it, Shankar.
No, it's my pleasure. Thank you, Shashank.
Thank you. Thank you guys. I hope you enjoyed this podcast with a lot of knowledge. And if you have some time, please click on the subscribe button. This would really help us grow our channel and also get some amazing guests that can give you superb knowledge all the time.